The rhythm of the auction, a story of value and discovery. Once upon a time, in a bustling, ever-shifting marketplace, there lived a community of traders who sought a single truth: value. They used a map called the market profile to understand the collective mind of the market. This map was built on time and volume, and it revealed the marketplace's deepest secrets. At the center of this map was the value area, VA, the neighborhood where 70% of all trading took place. Within this neighborhood, the market felt safe, comfortable, and content. And at the absolute heart of the value area sat the point of control, POC. The POC was the busiest, most crowded intersection in the entire market. It was the price where the most trading had occurred, the ultimate point of agreement between buyers and sellers. This was a state of balance. In this balanced world, prices gravitated towards high-volume nodes, HVNs. These were large, dense peaks on the profile chart, representing fair prices where buyers and sellers happily traded back and forth for hours. It was a comfortable plateau, but comfort breeds complacency. Suddenly, a whisper of new information rippled through the crowd. The old prices no longer made sense. The market woke from its slumber, transitioning from balance to imbalance. Driven by a sudden urge for discovery, aggressive buyers took control, sweeping the market upward. Prices tore away from the cozy point of control and the dense high-volume nodes. The market entered a phase of vertical exploration, searching frantically for a new area of agreement. As the price rocketed higher, it left behind low-volume nodes, LVNs. These were sharp valleys and empty spaces on the profile chart, zones where the price moved so fast that hardly any trading took place. The LVNs were a sign of rejection. Neither side wanted to do business at these unstable, fleeting prices. They were the bridges the market crossed to find its next destination. Finally, the frantic upward charge began to slow. The aggressive buying subsided as prices reached a level that attracted a wave of new sellers. The market paused, caught its breath, and began to trade back and forth once again. A new high-volume node began to form, a new value area began to shape itself, and a new point of control emerged. The journey of discovery was complete, and the market had found a new balance, until the next whisper of change would start the dance all over again. Now, let's visualize this transition from balance, through the gap of discovery, and into a new state of value. The rhythm of the auction, a story of shape and structure. We previously witnessed the marketplace shift from balance to imbalance, as aggressive buyers broke away from the old value area. This journey of discovery didn't just move prices, it etched unique patterns onto the market profile map, 4 classic shapes that tell us how that transition occurred and what the market believes now. Let us explore the diverse architectures of value. The balanced D shape, the quiet plateau. When the market is in true balance, as we saw in our initial state, it forms a perfect D-shaped profile. The histogram, with its single high-volume node and point of control, POC, centered in the value area, resembles a classic bell curve. Buyers and sellers are in deep agreement, happily rotating prices around the established fair value. This is the comfort zone of consolidation, where time passes slowly and range is respected. The P-shape, upward discovery and long extensions. This story begins when the quiet D shape is violently disrupted. As aggressive buyers seize control, they create the vertical imbalance we visualized earlier. However, a specific kind of auction often follows, a massive price extension higher, but all the trading volume accumulates at the bottom of the structure. The result is a profile that looks exactly like a capital P. The long vertical stem consists entirely of low-volume nodes, LVNs, zones of rejection and rapid ascent. The thin, rounded top shows that while the market found new higher prices, it didn't yet accept them. The main value is still trapped far below. The B shape, responsive rotation and value rejection. Conversely, if the aggressive action fails to find acceptance at higher prices, we get the B shape. This profile often starts as an aggressive breakout attempt higher, leaving a stem of LVNs, but then encounters fierce resistance, the responsive sellers we discussed. The market pauses, catches its breath, and then begins to rotate back down into the lower distribution. The value is successfully relocated lower, creating a wider, rounded profile at the bottom and rejecting the fleeting upper prices. It's the story of a failed breakout and the triumphant return of sellers. Double distribution, new balance and multi-level value. Finally, the market may achieve true discovery and value relocation through a multi-stage process, forming a double distribution profile. Here, the initial breakout creates a P-shaped stem, but instead of failing, the buyers manage to establish a new consolidation area higher up. You will see two distinct D-shaped profiles, two complete balance areas, separated by a narrow stem of LVNs or a liquidity gap. The lower distribution was the old value, the higher distribution is the newly accepted value, representing the definitive relocation of the market's center of gravity. The long-term perspective, crafting the composite. We've learned that the marketplace shifts from balance to imbalance, and that this discovery leaves classic structural shapes. But these single sessions, while powerful, are fleeting. To understand the deeper intent and established long-term value, we must learn to merge. This is the art of the composite profile. If you look at the left of our map, you see the inputs, single daily profiles, let's say from Monday, Tuesday, and Wednesday. Each tells its own story of discovery or consolidation, some wide and balanced, others trending and thin. The process of addition. How do we combine them? Watch the process unfolding in the second panel. Single profiles are not merely stacked, they are integrated. Their TPO structures blend. In simple terms, if you had 2 hours of trading at price X on Tuesday and 1 hour at price X on Wednesday, your composite now shows 3 hours at price X. The data flows together, turning multiple single stories into one unified history. The rules professionals live by, however, professionals don't merge randomly. This third panel defines the rules and methodology. We only merge days that share context and relevance. For example, Rule 1. We merge consecutive days with similar market structure, e.g., merging 2 consecutive consolidation days to see the true balance. Rule 2. We look for POC overlap. If daily points of control align perfectly, they represent strong acceptance, urging us to merge and broaden that value area. Rule 3. We merge by key level context. If an impulsive trend day, like the P shape, breaks out but immediately finds acceptance at an old balance area's high, we merge the new and the old structure to confirm the migration of value. The rules dictate that context is everything. The final composite profile. Finally, on the right, see the result. The composite profile, the multi-day view. Notice how much larger, wider, and smoother this distribution is compared to any single day. It dwarfs the original inputs. This structure now defines a master value area and identifies composite points of control, CPOCs, and long-term high-volume nodes, LHVNs. These aren't just one day's consensus, they are the result of multi-session agreement. The market's truest, longest-term destination is revealed. The initial balance, IB, is the foundation of institutional day trading strategy. It establishes the initial boundaries of the session, allowing Wall Street algorithms to categorize market conviction and predict the afternoon's behavior with high mathematical probability. The core concept. Defining the initial balance. The initial balance represents the price range established during the opening phase of the trading session. While retail traders often focus on the very first minutes of the open, institutional desks define the IB across 3 specific, standardized time horizons. The 30-minute IB, the price range of the first 30-minute period, the A period in a TPO profile. This represents the immediate, highly volatile reaction of market participants executing overnight orders and reacting to morning news catalysts. The 60-minute IB, the standard institutional benchmark, spanning the first 2 TPO periods, A and B. This 60-minute range captures the entry of commercial, higher timeframe participants who wait for the initial opening noise to settle before committing size. The 90-minute IB, the extended balance window, covering the first 3 periods, A, B, and C. If the market remains strictly within this range for the first hour and a half, the probability of a violent, trending breakout decreases significantly, shifting institutional strategy heavily toward mean reversion. Probability dynamics, the math behind the first hour. Wall Street uses the 60-minute initial balance as a critical statistical filter. The behavior of price relative to this range yields definitive probabilities that guide automated execution systems. The 80% rule, IB extension probability. Historically, on any given trading day, there is an approximate 80% to 85% probability that the market will break and extend beyond at least one side of the 60-minute IB high or IB low during the session. True, inside days, where price stays completely bounded by the first hour's range all day, occur less than 20% of the time. Knowing this, institutions avoid buying the exact IB high or shorting the exact IB low early in the session. The IB width filter. Algorithms instantly calculate the volatility of the IB. If the 60-minute IB range is exceptionally wide, standard deviations above the historical average, the probability of a sustained trend day drops. The market has likely exhausted its daily energy in the first hour, favoring a rotational, range-bound day. Conversely, an exceptionally narrow IB indicates compressed energy, raising the probability of a massive, directional breakout extension. Classification of day types and execution rules. Based on how price breaks or respects the initial balance boundaries, the session is classified into specific profiles, each dictating a strict institutional playbook. Trend day, high conviction. The market opens and aggressively drives directionally, breaking out past the IB boundary early in the session and continuously expanding the range. The profile structure. It forms a long, thin, vertical profile with very few overlapping TPOs and high volume extending linearly. Institutional rule. Never trade counter-trend. Algorithms are programmed to buy shallow pullbacks or join the momentum directly, as responsive counter-trend sellers are completely absent. Normal variation day, moderate conviction. The market establishes the IB, and later in the session, a higher timeframe participant enters to disrupt the balance, extending the range beyond one side of the IB. The profile structure. The range extension typically stretches out by an amount roughly equal to, or a fixed multiple of, the initial IB width. Value eventually establishes a new D, or P, B, shape outside the original boundary. Institutional rule. Wait for the extension to complete, then look for responsive rotation to build out the new value area upper or lower boundary. Neutral day. Two-sided volatility. The market expands past both the IB high and the IB low during the session. This represents a violent tug-of-war where aggressive buyers push price up, only to encounter even stronger responsive sellers who slam price back down through the entire range to break the opposite side. The profile structure. A wide, fat distribution with elongated tails on both ends, centering the final point of control, POC, directly in the middle of the day's expanded range. Institutional rule. Treat the extremes as highly unreliable for breakout trading. Algorithms shift to fade the outer edges, betting that the market will inevitably gravity pull back to the central POC intersection. Let us visualize the structural blueprint of the initial balance, its time horizons, and how the market breaks out of this opening range to discover new value.